Hey everyone, and welcome back for another deep dive. Today we're going to be diving into ICT trading,
Yeah.
specifically for beginners. So if you're new to trading and you've heard all this stuff about ICT, you're in the right place.
Absolutely. This is going to be a really good one.
Awesome. So what is ICT and why should people care?
ICT stands for Inner Circle Trader. It was developed by a guy named Michael Huddleston, and it's a methodology that focuses on order flow, market structure, and understanding how the institutions trade. And why people should care is because ICT concepts are some of the most powerful concepts you can use when it comes to trading.
Yeah, so it's not just another indicator or like a fancy system. It's
Exact.
more about reading the market.
Yeah, it's getting down to the nitty-gritty of like price action and understanding how the market moves.
Cool. So one of the things that I found really interesting about ICT is the focus on the daily chart.
Right.
Can you talk a little bit about that?
Yeah, so the daily chart is really important in ICT. ICT traders use the daily chart to identify key levels, support, and resistance, and really just get a sense of where the market is going. It's the foundation.
Yeah, it's like a roadmap.
Yeah, exactly. It's like the macro view before you zoom in.
Yeah, exactly. So you're not just looking at the 5-minute chart or the 15-minute chart. You're actually stepping back and saying, okay, what's the big picture here?
Exactly, yeah. And one of the really cool things about ICP is that ICT teaches that the market likes to retrace to the previous day's high or low. And this is something that I personally use all the time, and it's super powerful.
So the market has like a short-term memory.
Yeah. Well, that's how I like to think about it, right? You look left on the chart,
Right.
you
Yeah.
see what the previous day did, and there's a high probability that the market will at least test those levels again.
So that kind of helps you anticipate where price might go.
Exactly. Yeah. And
Yeah.
that's the key to trading, right? Anticipating instead of reacting.
So instead of just chasing price, you're actually like kind of planning ahead a little bit.
Yeah, you're getting ahead of the curve.
Yeah. And I know from personal experience that that used to be something that I really struggled with. I would just be so focused on like all these indicators and all these different time frames, and I was just completely lost.
Right.
So focusing on the daily chart has really helped me to simplify my trading and to actually understand what the market is doing.
Yeah, and a lot of new traders overcomplicate things. They think that they need all these fancy indicators and systems, but really the best way to trade is to keep it simple and to focus on price action.
So you don't need like 100 indicators on your chart.
Nope, price is all you need.
Yeah, price action is key. So speaking of price action, how does market structure play into ICT?
Well, market structure is absolutely essential to ICT, and I'd say trading in general. It's really the foundation of understanding how the market moves.
Okay, so could you give us a quick overview of what market structure is?
Yeah, market structure is simply the identification of swing highs and swing lows to determine the trend of the market. So in an uptrend, you're going to have higher highs and higher lows. In a downtrend, you're going to have lower highs and lower lows. It's really as simple as that.
So it's like a staircase, right?
Exactly. And the market is either making higher highs and higher lows
Yeah.
or lower highs and lower lows.
And sometimes it's going sideways.
And sometimes it's going sideways, which we call a range. Yeah.
Yeah. But for a lot of beginners, it can be really tough to identify those swing highs and swing lows.
It can be, yeah.
Yeah.
It's a skill that takes practice and experience to develop, that's for sure.
But there are some things that people can do to kind of help them see it better.
Yes, definitely. One thing I always tell my students is to start with a higher time frame, like the daily chart, and work your way down to lower time frames. This helps to filter out the noise and see the bigger picture of what the market is doing.
Right.
And another tip is to just practice, practice, practice. Take a candlestick chart and start marking the swing highs and swing lows.
Yeah, and don't be afraid to make mistakes.
Exactly. The more you do it, the better you'll get at it.
Yeah, you'll start to see those patterns and you'll be like, oh, okay,
Right.
I see what's happening here.
And eventually it'll become second nature. You'll just be able to look at a chart and instantly recognize the market structure.
Yeah, cool. So we've talked about the daily chart, we've talked about market structure. What other ICT concepts are important for beginners?
Well, there's a lot of other great ICT concepts, but I would say two of the most important ones for beginners are fair value gaps and the AMD model.
Okay.
I know those sound like fancy terms, but they're
Mhm.
really not that complicated. And once you understand them, they can be really powerful tools for finding trading opportunities.
Awesome. Well, let's dive into those in the next part.
Sounds good to me.
All right, we'll be right back after the break.
Welcome back to the deep dive, everybody. So before the break, we were talking about some pretty powerful ICT concepts.
like fair value gaps and the AMD model.
Right.
So let's start with fair value gaps. What are those and why are they important?
Yeah, so fair value gaps, or FVGs for short, are basically just areas on the chart where prices moved really quickly, leaving a gap, and it's essentially an imbalance in the market. And these imbalances, they tend to get filled.
Okay. So price doesn't like to leave these gaps unfilled.
Exactly. It's like a vacuum. The market wants to go back and fill those gaps.
Okay. So how do you use these FVGs to actually find trades?
Well, the first step is to identify them on the chart, and you can do that by looking for areas where price has gapped up or down significantly. And then once you've identified the FVG, you need to wait for price to come back and test that level. And when price does come back to test the FVG, that's when you can look for trading opportunities.
Okay, so you're basically looking for price to kind of like retrace back to that gap.
Exactly, yeah, and you want to see how price reacts at that level.
Right.
So if price comes back to test the FVG and it rejects strongly, that could be a good sign to enter a trade in the opposite direction of the gap.
So if it's a bullish FVG, price rallies up and leaves this gap and then comes back down to test it and rejects off of it, that could be a good sign to go short.
Exactly, yeah. And on the other hand, if price comes back to test the FVG and it breaks through and continues moving in the direction of the gap, that could be a sign that the move is going to continue.
Yeah, so you're using the FVG as like a confirmation.
Right, it's like another piece of the puzzle.
Yeah, exactly. And I think one of the things that's really cool about FVGs is that they can occur on any time frame.
Yeah, you'll see them on the 1-minute chart all the way up to the monthly chart.
Yeah, so it's not just like a daily chart thing.
Right. But I do like to use them on the higher time frames because I feel like they're more reliable.
Yeah, I think that makes sense. And there's also that rule about like the 50% rule with FVGs.
Right. So with a bullish FVG, if price rallies and closes above the 50% level of that FVG, that's a strong indication that price is going to continue going up.
Yeah, so that's kind of like a confirmation that the buyers are in control.
Exactly, yeah.
Yeah.
Buyers are in control. We're probably going to continue higher.
Okay, cool. So that's FVGs. What about the AMD model? What is that?
The AMD model. So the AMD model is basically a way to understand how smart money moves in the markets. It's an acronym that stands for accumulation, manipulation, and distribution.
Okay.
So these are basically the 3 phases that smart money goes through when they're moving the market.
Okay, so let's break those phases down. What happens during the accumulation phase?
So during the accumulation phase, smart money is buying up the asset that they want to move. They're accumulating their positions at a relatively low price. And this phase can take a while.
Okay, so they're not just like jumping in all at once.
Nope. They're being patient and they're waiting for the right opportunity to start moving the market.
Okay, so it's kind of like a stealth operation.
Yeah, exactly. They're trying to do it as quietly as possible.
Okay, so that's the accumulation phase. What about the manipulation phase? What happens there?
So the manipulation phase is where things start to get interesting. So once smart money has accumulated a large enough position, they start to manipulate the market in order to get more buyers or sellers trapped. So this is where they'll do things like create fake breakouts or breakdowns or stop runs to get people to enter trades in the wrong direction.
So they're kind of like tricking people.
Yeah, they're playing mind games with the retail traders.
Wow, that's pretty crazy. So how do they do that? Like, what are some of the things they'll do to manipulate the market?
Well, they can do things like create a false breakout above a key level of resistance and then quickly reverse back down and trap all the buyers who bought into that breakout. Or they might do the opposite.
Right.
Create a false breakdown below a key level of support and then trap all the sellers.
So they're basically like setting traps for people.
Exactly. And once they've trapped enough people, they're ready to move on to the next phase.
So that's when they distribute.
Exactly, yeah.
Okay. What happens during the distribution phase?
So the distribution phase is where smart money starts to unload their positions. They've accumulated a large position at a low price, and now they're ready to sell it off to the retail traders who are chasing the move.
So they're basically taking profits.
Right. And they're doing it at the expense of the retail traders.
So the retail traders are kind of like the last ones to the party.
Yeah, pretty much. And by the time they get in, the smart money is already on their way out.
So how can traders use the AMD model to actually find trades?
Well, the key is to identify which phase of the AMD model the market is in. So if you can identify the accumulation phase, you can look for opportunities to buy the asset that smart money is accumulating.
Good.
And if you can identify the manipulation phase, you can avoid getting trapped in their traps.
Right.
And if you can identify the distribution phase, you can look for opportunities to short the asset as smart money is distributing.
So it's all about timing.
Yeah, exactly. Timing is everything in trading.
Yeah. So how can people actually identify those phases on the chart?
Well, it takes practice and experience to be able to identify the phases accurately, but there are some things you can look for. So during the accumulation phase, you'll often see price consolidating in a tight range, and you'll see low volume and low volatility. And then during the manipulation phase, you'll start to see volume and volatility pick up. And you'll see price start to make these sharp moves up and down.
Yeah.
And then during the distribution phase, you'll see price break out of that range and make a strong move in one direction.
Okay, cool. So
Yeah.
it's kind of like a progression.
Right. It's a story that unfolds on the chart.
Yeah, that's a great way to put it. So the AMD model, it's kind of like a framework for understanding how the market works.
Exactly. Yeah. It helps you to see the big picture and to avoid getting caught up in the noise.
Awesome. So we've talked about FPGs, we've talked about the AMD model. What other ICT concepts we need to cover? All right, so we've talked about fair value gaps, we talked about the AMD model,
Right.
and I think now it's time to get into like the actual entries, right?
Right. Yeah. Let's talk about how to actually get into these trades.
Yeah, how do we actually pull the trigger?
So in ICT, one of the main things we're looking for is a market structure shift, or what's called a breaker.
Okay.
And essentially what this is when price breaks a key level in the market, right? So in an uptrend, we're looking for price to break above a previous high.
Right.
Or in a downtrend, we're looking for price to break a previous low.
So it's not just like any random break of structure. It's like,
Exactly.
oh, this is a significant level.
It has to be a key level.
Okay.
And ideally, that key level also aligns with other ICT concepts like fair value gaps.
Right. So it's all kind of coming together.
Yeah, it's like putting the pieces of the puzzle together.
Yeah, and I think one of the things that's really important to remember is that we're not just looking for like one candle to break that level.
Exactly.
We're looking for a confirmation.
We want to see follow through.
Yeah.
We want to see momentum.
Okay, cool. So we've got our entry trigger. What about risk management?
Right? Risk management is probably the most important aspect of trading.
Absolutely.
If you don't manage your risk, you're going to blow up your account.
Yeah, and I think that's something that a lot of new traders don't really understand.
They just think about the entries. They
Yeah.
don't think about protecting their capital.
Yeah, so how do you approach risk management?
So first and foremost, you always want to use a stop loss order.
Okay.
A stop loss order is basically an order that you place with your broker that automatically exits your trade
Right.
if the price moves against you by a certain amount.
So it's a safety net.
Exactly. It's there to protect you from losing too much money on any one trade.
So where do you typically place your stop loss?
Well, it depends on the trade, but a good rule of thumb is to place your stop loss just beyond a recent swing high or swing low.
Okay, so you're using market structure to kind of determine your stop loss placement.
Exactly, because those swing highs and swing lows are often areas where other traders have their stops as well. So if price breaks through those levels, it can trigger a cascade of stop losses, which can lead to a big move in the market.
Right, so you're kind of like piggybacking on the stops of other traders.
Exactly.
Okay, that's a really cool concept.
Yeah.
So we've got our entry, we've got our stop loss. How much are you actually risking on each trade?
So I personally risk no more than 1% of my account on any one trade.
Okay.
And I actually divide that by 10.
Really? So you're only risking like 0.1% per trade?
Yep. And the reason I do that is because I want to stay in the game for the long haul.
Right.
Trading is a marathon, not a sprint.
Yeah.
And if you're risking too much on each trade, you're going to blow up your account eventually.
I get tired.
Yeah,
Yeah. So it's better to be conservative and to protect your capital.
exactly.
And I think that's one of the biggest lessons that I've learned in my trading journey is that it's not about like getting rich quick, it's about preserving your capital and letting those wins compound over time.
Yeah, consistency is key.
Exactly. Yeah.
Yeah.
So it's better to have a bunch of small wins than to have like one big win and then a bunch of big losses.
Yeah, that's going to wipe you out.
Exactly. All right. So we've covered a lot of ground today.
We have.
We talked about ICT. We talked about fair value gaps, the AMD model market structure, entries, risk management. What's like the one thing you want listeners to take away from this deep dive?
I would say the biggest thing is just to keep it simple.
Okay.
A lot of new traders, they try to overcomplicate things. They're looking for that holy grail indicator or system. But really the best way to trade is to just focus on price action and market structure.
Yeah, and be patient.
Be patient.
Don't try to force trades.
Don't chase.
Yeah.
Wait for those high probability setups.
Yeah. And manage your risk.
Yes, absolutely.
Awesome. Well, this has been another great deep dive. Thank you so much for joining us.
Yeah, it's been a pleasure.
And we'll see you all next time.